By far the best book on investing ever written. Those aren't my words. Those are the words of Warren Buffett, a man who is arguably the greatest investor of all time. He isn't talking about a modern book on crypto, or a guide to day trading tech stocks. He is talking about a book published in 1949 by his mentor, Benjamin Graham, The Intelligent Investor. Welcome back to Book Summary YT. Today, we are not just summarizing a book, we are downloading an entire operating system for your financial life. If you have ever felt anxiety when the stock market crashes, or FOMO when it skyrockets, this video is for you. Benjamin Graham didn't teach people how to get rich overnight. He taught them how not to get poor. He taught the philosophy of value investing. Over the next 30 minutes, we are going to break down this massive text into actionable chapters. We will discuss the difference between investing and gambling, the manic depression of Mr. Market, the critical margin of safety, and exactly how to pick stocks whether you are a lazy investor or a hardworking one. Grab a notebook. This is the most important script we've ever covered. Let's dive into The Intelligent Investor. Part 1, Investment versus Speculation. Graham opens the book by drawing a line in the sand. Before you buy a single stock, you have to know, are you an investor, or are you a speculator? In the modern world, we use these words interchangeably. We say, I'm investing in crypto, or I'm investing in this penny stock. Graham would stop you right there. He has a very specific definition. Quote, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Let's break that down. There are three distinct elements here. 1. Thorough analysis. You aren't buying a stock because you heard a tip at a party. You are looking at the business, the balance sheet, and the earnings. 2. Safety of principal. Your primary goal isn't just to make money, it is to not lose your initial money. 3. Adequate return. You aren't looking for a lottery ticket. You are looking for a reasonable return on your capital over time. If you buy a stock simply because you think the price will go up next week because everyone is talking about it, you are not investing. You are speculating. Graham doesn't say speculation is illegal or even immoral. He just says it can be fatal to your wealth if you don't realize you are doing it. If you are speculating, you are gambling. And like any casino, the odds are against you. The intelligent investor realizes that a stock represents ownership in a real business. It is not just a ticker symbol that flashes green or red. If you own a stock, you own a piece of a bakery, a car manufacturer, or a software company. If that company makes money, you make money. That is the mindset shift. Part 2, the two types of investors. Once you decide to be an investor and not a gambler, Graham asks you to look in the mirror. What kind of investor are you? He categorizes everyone into two groups. 1. The defensive or passive investor. 2. The enterprising or active investor. This is where most people get it wrong. Most people think they want to be enterprising investors because they want to beat the market. They want high returns. But Graham argues that your choice shouldn't be based on how much money you want to make. It should be based on how much work you are willing to do. The defensive investor places their main emphasis on the avoidance of serious mistakes or losses. They want freedom from effort, annoyance, and the need to make frequent decisions. If you have a full-time job, a family, and hobbies, and you don't want to spend 10 hours a week reading financial reports, you are a defensive investor. And that is okay. Graham says the defensive investor can get a perfectly respectable result with very little effort. The enterprising investor, on the other hand, is willing to devote time and care to the selection of securities. They treat investing as a business or a serious hobby. They are trying to beat the average. Here is the key insight: the return you get is not determined by the risk you take, but by the work you put in. If you are a defensive investor, your strategy should be simple. Graham suggests a split between high-grade bonds and high-grade common stocks. In his time, he suggested a 50-50 split. If the market gets too high, you sell some stocks and buy bonds. If the market crashes, you sell bonds and buy cheap stocks. In modern terms, and we'll get to this later, the defensive investor is the perfect candidate for index funds. But what if you want to be enterprising? What if you want to pick stocks? Well, Graham has rules for that too, but he warns you, it is hard work. If you try to be an enterprising investor but you only put in defensive effort, you will get slaughtered. Part 3, Inflation, the silent killer. Before we get to stock picking, we have to talk about the enemy. Graham dedicates early chapters to inflation. Many people think the safest place for their money is cash or a savings account. Graham argues the opposite. He says that cash is a guaranteed loss over the long term because of inflation. If you keep all your money in the bank, and inflation is running at 3% or 4%, you are losing purchasing power every single year. Stocks, however, offer a hedge against inflation. Why? Because stocks are businesses. If the price of bread goes up, the bakery charges more for bread. Their revenue goes up, their earnings go up, and eventually, their stock price goes up. Graham warns us not to rely entirely on bonds or cash. You need equities, stocks in your portfolio to protect your purchasing power against the erosion of time. Part 4, Mr. Market. Now we arrive at the most famous metaphor in financial history. This is the psychological core of the book. Meet Mr. Market. Graham wants you to imagine that you own a share in a private business. You have a partner named Mr. Market. Mr. Market is very obliging. Every single day, he comes to your office and tells you what he thinks your interest in the business is worth. Furthermore, he offers to either buy your share or sell you an additional share at that price. Here is the catch: Mr. Market is an emotional maniac. Some days, Mr. Market is euphoric. He sees only sunshine and rainbows. He sets a ridiculously high price for your business shares. Other days, Mr. Market is depressed. He sees only trouble ahead. He is terrified, and he sets a ridiculously low price for your shares. So, what should you do? Should you let Mr. Market's mood swings determine how you feel about the value of your business? If he is depressed and offers to sell you his shares for pennies, should you panic and sell yours too? No, you should buy from him. If he is manic and offers to buy your shares for a fortune, should you get greedy? No, you should sell to him. Graham's point is this: the market is there to serve you, not to instruct you. Most investors look at the stock price to tell them how the company is doing. If the price is down, they think something is wrong. The intelligent investor looks at the business to tell them what the stock is worth. If the business is healthy but the price is down, they see an opportunity. You must maintain your emotional discipline. You cannot let the market's mood swings dictate your financial decisions. Part 5, Stock Selection for the Defensive Investor. Okay, let's get into the numbers. Let's say you are a defensive investor. You want safety and you don't want to watch the market all day. But, you still want to pick individual stocks rather than just an index fund. Graham gives us a specific set of criteria to ensure we are buying quality. He calls this quantity of quality. Here are his 7 rules for the defensive investor. 1. Adequate size of the enterprise. Don't buy small, volatile companies. Buy the giants. In today's terms, think large-cap companies with billions in revenue. 2. A sufficiently strong financial condition. Their current assets should be at least twice their current liabilities. Simply put, they have enough cash to pay their short-term debts. 3. Earnings stability. Some earnings for the common stock in each of the past 10 years. No years of losses. We want consistency. 4. Dividend record. Uninterrupted payments for at least the past 20 years. Dividends are proof that the company is actually making real cash. 5. Earnings growth. A minimum increase of at least 1/3 in per-share earnings in the past 10 years. We don't need a rocket ship, but we need a company that is growing. 6. Moderate price-earnings ratio. The current price should not be more than 15 times the average earnings of the past 3 years. This prevents you from overpaying for hype. 7. Moderate ratio of price to assets. The current price should not be more than 1.5 times the book value. This list is strict. If you run a screen of the S&P 500 today using these rules, you might only find a handful of companies. And that is the point. Graham is trying to protect you from making a mistake. If a company passes all these tests, it is statistically unlikely to go bankrupt and take your money with it. Part 6, Stock Selection for the Enterprising Investor. Now, what if you are the enterprising investor? You are willing to dig deeper. You want to find diamonds in the rough. Graham suggests looking for bargain issues. These are stocks selling for considerably less than their true value. One of his favorite strategies for the enterprising investor is buying stocks selling below their net current asset value (NCAV). This is often called net investing. Essentially, you take a company's current assets, cash, inventory, receivables, and subtract all liabilities, short-term and long-term debt. If the stock market cap is lower than that number, you are essentially buying the company for free. It's like buying a wallet containing $100 for the price of $60. Even if the business closes down tomorrow and liquidates everything, you would make a profit. However, Graham warns that these opportunities are rare in modern bull markets. They usually appear during deep crashes or in neglected sectors. For the enterprising investor in normal markets, Graham focuses on growth at a reasonable price. He doesn't mind buying a growth company, but he refuses to pay a P/E ratio of 50 or 100. He looks for unpopular large companies, maybe a tech giant that had a bad year, or a pharmaceutical company facing a temporary lawsuit. He looks for temporary trouble in a permanently strong business. Part 7. The margin of safety. If you forget everything else in this video, remember this next concept. Graham says that the secret of sound investing can be distilled into 3 words: margin of safety. What does this mean? Let's use an engineering analogy. If you are building a bridge, and you know that the heaviest truck that will ever cross it weighs 10,000 pounds, do you build the bridge to hold exactly 10,000 pounds? Of course not. If the truck is slightly heavier, or the wind blows, the bridge collapses. You build the bridge to hold 30,000 pounds. That extra capacity, the gap between 10,000 and 30,000, is your margin of safety. In investing, it works the same way. If you analyze a company and calculate that the intrinsic value, the real worth, of the stock is $100, do you buy it at $99? No, because your calculation might be wrong. The economy might turn. You wait until the stock is selling for $60 or $70. The difference between the price you pay, $60, and the value you get, $100, is your margin of safety. This margin does 2 things. 1. It protects you if your analysis was wrong or if bad luck hits the company. 2. It provides the fuel for your upside returns. Graham says, the function of the margin of safety is, in essence, that of rendering an accurate estimate of the future unnecessary. You don't need to predict the future perfectly if you bought the asset cheap enough. If you buy $1 for 50 cents, a lot can go wrong and you will still be okay. Part 8. Funds and advisors. Graham was writing in 1949, but he foresaw the rise of the mutual fund industry. He poses a question: should you pay someone else to manage your money? His answer is skeptical. He notes that most funds do not beat the market averages over the long term, especially after you account for their fees. For the average defensive investor, Graham suggests that unless you can find a manager with a proven, long-term track record of integrity, which is rare, you are better off mimicking the market averages yourself. Today, this is a direct endorsement of index funds. If Graham were alive today, he would likely tell the defensive investor to buy a low-cost S&P 500 index fund or a total world stock market fund. This gives you instant diversification, you own the biggest and best companies, and you don't have to stress about analyzing balance sheets. You guarantee that you will do as well as corporate America does. Part 9. Graham's warning on market fluctuations. As we near the end of the summary, we have to touch on Graham's warnings about market cycles. History repeats itself. The players change, the technology changes, but human psychology does not change. Greed and fear are constant. Graham warns that there will be times when the market is irrationally exuberant. People will buy stocks simply because they are going up. They will ignore the P/E ratios. They will say, this time is different. Graham says, it is never different. When valuations get too high, a correction is inevitable. The intelligent investor knows this. They don't try to time the exact top, but they recognize when the market is dangerous. They might rebalance their portfolio, selling some expensive stocks and buying bonds. And when the crash comes, and everyone else is selling in a panic, the intelligent investor steps in. They see the clearance sale. They use their margin of safety. Conclusion: the intelligent investor today. So, does the intelligent investor still hold up today, almost 80 years later? The specific companies Graham mentions, railroads and old utilities, might not be the hot stocks of today. But the principles are timeless. Analysis versus speculation, still true. Don't buy crypto just because it's trending. Mr. Market, still true. Look at how volatile tech stocks are. Margin of safety, still true. Buying overvalued assets is the quickest way to destroy wealth. Benjamin Graham teaches us that investing is not about beating the guy next to you. It's about controlling yourself. It's about having a plan that fits your personality and sticking to it when the world is going crazy. To summarize, here is your cheat sheet for being an intelligent investor. Know your type: are you defensive, passive, or enterprising, active? Don't speculate, treat stocks like ownership in a business. Use volatility: Mr. Market is your servant, not your master. Buy when he is sad, sell when he is happy. Demand safety, always buy with a margin of safety. Never overpay. Warren Buffett said that if you follow the advice in chapters 8 Mr. Market and 20 Margin of Safety, you will not get a poor result from your investments. If you want to build wealth that lasts a lifetime, stop chasing the next big thing, and start investing with intelligence. Thank you for watching this deep dive on Book Summary YT. I want to know, are you a defensive investor or an enterprising investor? Let me know in the comments below. If you found value in this video, please hit the like button, it helps Mr. Algorithm show this video to more people. And make sure to subscribe for more summaries of the world's greatest books. Until next time, keep reading, and keep investing intelligently.